What's up, everyone? Welcome back to another episode of the eCommerce Influence Podcast. My name is Austin Brawner, and I am so excited to bring you my friend, a recurring guest, Taylor Pearson. Taylor has been a friend for a long time. I first met him on a bus headed to an e-commerce fuel event, and this was about, 7 years ago, something like that. And we've stayed in touch, and one of the things I respect so much about Taylor is his ability to follow his interests and create value in what he is learning about and create new products and interesting things around what he's interested in. And so one of the things he's gone down the rabbit hole on is the traditional financial system and in creating products that help people, investors, mitigate tail risk in their portfolio. What does it actually mean? That means create a financial product that goes up when all things go down. And so the last time he was on the show, we talked about standard operating procedures, which he's an expert at. This time we talk a lot about what's happening in the world, how to better preserve your wealth when it seems like the whole world's going crazy. We talk a little bit about what tail risk means and things you can do as an entrepreneur to offset the risk that you've taken by going all in on a business. So it's a very interesting interview. Really appreciate Taylor coming on and talking to me. And I think you guys will get a lot out of this. If you are interested in building and preserving wealth, which I think most of you are, this is an episode for you. So let's dive into it. Taylor, welcome to the show.
Austin, thanks for having me, man. It's good to be here.
Yeah, man, I'm excited to have you back. I think it's been quite a while. It's been a few years, and many things have changed in your life since last time you were on the show. Last time you were on the show, we were talking a little bit about standard operating procedures and all those different things, which are definitely things that you are super dialed in on. But since then, you've done a massive deep dive into the financial world. And I'd love to start there. Like, what have you been working on for the last couple of years? Let's kick it off with that.
Yeah, so my main thing right now, I run a tail risk and long volatility hedge fund. We can get more into what that means, but basically it means sort of betting on big unexpected things happening in traditional financial markets. So, S&P derivatives, that kind of stuff is most of what we do. So we launched, we started working on that project. I have a partner. We started working on it. We kind of came together because we were both personally interested, kind of looking for someone to do this for our own portfolios. Kind of met through that mutual interest in 2019 and quickly realized that there just weren't any options out there, that most of the sort of the ways to do that, either it requires being, quite sophisticated yourself, like a background in options trading, like you worked on a desk at Wall Street, somewhere in Wall Street and traded options, or you can write, a $5 million check to a big hedge fund that can kind of do it for you. So we came up with this structure to basically offer tail risk and long volatility solutions to like more retail sized investors at sort of lower check sizes. So that was kind of where we started in September.
And that's Mutiny Fund.
So the firm is called Mutiny Funds. We have two different offerings. Basically, one, we have the volatility one that I mentioned, and then September of 2021, we launched a multi-strategy fund, which uses the volatility fund as part of it, but also does equities, bonds and fixed income, and commodities. So that's kind of our whole portfolio solution. So the volatility piece in our minds was always a part of a broader portfolio. You don't just want to be betting on bad things happening or big things happening, because most of the time they don't. But you want to have that as sort of a piece.
Cool. This is really fascinating. And I think it's especially interesting right now. One of the reasons I want to bring you on is because there's a lot of conversation around what the hell is going to go on in the future. Like I've had lots of conversations with other entrepreneurs, people in the investment world. And a lot of the conversation that we have offline is like, what is going to happen? At what point are we going to end up paying for all of the transgressions that we've had related to printing money or to, just unscrupulous uses of funds and debt and all these different things? But what has been interesting is we really haven't. It's been like up only in the stock market and the crypto market until fairly recently. We've seen something a massive correction in the crypto market and a less massive correction, but still a correction in the traditional finance market. Why should people be thinking about tail risk? Why is it something that you were interested in? Why is it important?
So I think for me, I don't, there's a whole question of like market timing and when things are going to happen. My answer to that is always like, I don't know. And sort of how I think about structuring an investment portfolio is based on, I just assume I have zero ability to predict any sort of macroeconomic moves. What is inflation going to do? What is the Fed going to do? I just assume I have sort of zero predictive ability about evaluating those things. So the kind of way I approach it is, let's look at the long stretch of history, right? Sort of what happens, and then add some sort of qualitative thinking overlay to, how might that be different going forward, and sort of how should you adjust things. So I think, for most people, and the way most portfolios are constructed is there's been this real sort of rise of the stock bond focused portfolio over the last 30 years in what's been a bond bull market and largely a stock bull market, right? And that, sort of any sort of stock bond focused portfolio from roughly 1990 to present has worked very well. It's worked especially well sort of following the dot-com crisis because bonds and stocks have mostly been uncorrelated with each other. So when stocks went down, typically the Fed would cut interest rates. That would cause bond prices to rise. And so you lose some money on the stock side, you make some money on the bond side, you rebalance, then stocks go up, you make more money on the stock side. If you look further back than that, and I'm talking just about the US right now, but this is true of other markets as well, that is typically not the case. It's fairly common for stocks and bonds to be correlated with one another for extended periods of time. So if you look at sort of the stagflationary period in the US, kind of circa 1965 to 1985, for a good portion, I think probably most of that period, you had fairly high levels of stock and bond correlation, and both of them were losing in real terms, right? The stock market was going up some, but inflation was even higher. And so in real terms, you were losing on sort of both sides of that equation. And then also, if you look, to look further back necessarily, right? But you have events like, 2008, the dot-com bubble, 1987 flash crash, March 2020 even, where you had these sort of tail events that really impacted the stock and bond focused portfolios. So kind of the way we think about it is what is sort of robust against, without being able to predict what the future macroeconomic environment is going to do, what is robust against sort of all the possible things. And so we think that some combination of all the major asset classes. I mentioned stocks, bonds, commodities, which that's, if you look back at sort of like the stagflationary period in the late 60s, 70s, early 80s, commodities were the asset class that did by far the best. And then some sort of tail risk or long volatility solution for when you have those big gaps down in markets like October 2008, March 2020. And you really have kind of just, if you look at just stocks, bonds, and commodities, what they don't do well is when you have these liquidity crunches. So the common saying is, in a crisis, all correlations go to one. Right. So it's like everything starts selling out at the same time. And if you pulled up a market dashboard in like March of 2020, like everything was red, right? And like everything was just going down at the same time. It seems like that's a function of liquidity, right? So it's like everyone needs liquidity right now. People are getting margin called, and they just have to sell everything that they own. And so that's sort of the place where volatility comes in. So a roundabout answer, but I think maybe a simpler way to say it is just, what are the different path dependencies, right? Like what are the things that could happen? And is there something in the portfolio that will cover that path dependency, right? So if we have inflation, what happens? If inflation folds out this way, what happens? If we have a sharp sell-off, what happens? If we have a slow sell-off, what happens? If markets keep going up forever, what happens? If bonds and stocks stay correlated, what happens? If bonds and stocks become uncorrelated, what happens? And thinking about balancing the portfolio around all those different path dependencies.
So my understanding from this, and you can correct me if I'm wrong here, but in order to do that, you're paying like somewhat of a little bit of like, you can think of like a tax on the day to day to offset. You're paying now so that to service something that in the future, if there's some sort of event like a liquidity event or some sort of a black swan type event, you're going to be covered where this small percentage, this part of your portfolio will outperform the rest of your portfolio. And the way that you do that is you pay now a small amount, like on a monthly basis, to make sure that when that happens, you can offset your losses with something else.
Yeah, that's right. And I think the way I think about it is like people talk about like, oh, the average returns of this strategy are X. There's sort of two ways of calculating an average. There's an arithmetic average and there's a geometric average. Your geometric average is like, there's also like your compound annual growth rate, or like CAGR, right? So like that's the average. That's what the portfolio actually gets. We call it like returns you can eat. That's what the actual assets are, that those can be cashed out. You can buy food, put it on the dinner table. Those are returns you can eat. The arithmetic average say, on average, the S&P returned 7% per year or whatever. There's a lot of variation around that average. And what happens there's not like a super intuitive way to do this, but if you just like play around with a spreadsheet, the big drawdowns are what really kills your long-term compound annual growth. So if you have a 50% drawdown in your portfolio, it takes 100% gain to get back. Now, small drawdowns aren't as damaging. So if you have a 5% drawdown, it takes a 5.3%. I think that's about right, 5.3, 5.4% gain to get back. So recovering from a 5% or 10% drawdown isn't that bad. It doesn't increase, or it increases sort of more than it increases at a greater rate. And so having things, kind of the way we think about it is like, really what we are is we're drawdown managers. We want to reduce the total drawdown, and that's what's going to improve the long-term compound annual growth rate. And I think that it's just very intuitive, right? You think about like adding something, sort of the closest analogy for long volatility or tail risk is like insurance, right? And the sort of common thing like, oh, insurance, it's a losing bargain. It's dumb. I shouldn't have this insurance because it doesn't make sense. And it's actually not, it's a lot of insurance contracts are actually win-win because of the way you're transferring the risk around. You're moving it to someone that can sort of afford. So like if when you're buying options, you're buying them from some $400 billion pension fund that's, has a volatility selling program that's 1%. Like it doesn't like that whole thing going to zero, even though it's $1 billion or $4 billion, whatever, doesn't really matter for them, right? They can afford, like just like an insurance company, right? They have their balance sheet, they can afford to do that. And so I think that's sort of the way we think about it, right? Which is how do we minimize the drawdown? And then to your point, typically sort of, not typically, sort of by definition, a more diversified portfolio is going to underperform. It's never going to be the best performing thing, right? So like in a year where stocks are going up a lot, owning a bunch of things other than stocks will do worse than just owning stocks. In a year when gold is going up a lot, owning a bunch of stuff other than gold will do worse than owning gold. So in a typical year, you're never going to sort of be a diversified portfolio is rarely going to be the best performer, basically never. But over many years, the idea is like it should perform, more diversified should perform better on a risk-adjusted basis.
Yeah, and even last year, it's like if you had 100% stocks, but you weren't 100% in Tesla, it's like you're still underperforming.
Right. Yeah. If you weren't like leveraged long Tesla calls, you weren't doing the best. Someone on Wall Street bets beat your portfolio.
Yeah. I was reading, I think it was Psychology of Money, which I thought was a really good book, really interesting book. And there was an interesting section where they were talking about risk tolerance, and it was talking about kind of how to determine your own level of risk tolerance. And this quote stuck with me. It was like, there are certain people that can't sleep if there's a chance that 50% of their portfolio could get wiped out. And then there are also people who can't sleep if they're not maximizing the returns to their portfolio. And those are, there's no right or wrong place to be. That's just the reality of human nature, and that certain people are wired differently, and you got to figure out your own level of risk tolerance and then adjust accordingly, right? And figure out where you want to put your money. And sometimes I have friends that do like what I look at, and I'm like, those are the most insane risk on trades I've ever seen. and a lot of them have worked out well recently because everything's been going up. But one thing I would like to go a little bit. Like,
let me actually, let me challenge that, or just like I sort of add a wrinkle to that I think is important. Is there's two, I guess if you look at like sort of classical, like if you like get a whatever bachelor's degree in finance or something, there's this idea of like an efficient frontier that there's always a best point of risk-adjusted returns on a portfolio. And then if you want more return, you can just apply leverage while still having the same risk tolerance. So if you want to increase your returns, there's two ways to do it. You can take concentration risk, right?
Yep.
So you can be 100% long in Tesla, or you can take leverage risk, which is you could have a very diversified portfolio, but you're going to run it at 300% exposure. And that's how you're going to get the return. So I think generally, and I don't know why this is, people are much more willing to take concentration risk than they are to take leverage risk. And I think, I don't know. I have a bunch of folk theories on that. Like, is it like a hangover from the Great Depression where like, people's grandfathers were bankrupt from like, having debt or something. But I think that's sort of an important thing. And I think a lot of times a modestly leveraged, highly diversified portfolio is going to do better, is going to do better risk adjusted than a, unlevered but highly concentrated portfolio. So I think there is a question of like, what's your risk tolerance? Like, what can you psychologically bear? But then there's a sort of separate question of like, what's the way to get the best risk adjusted returns? And I think it's important not to conflate those two things, which is like, this is what I think is the best portfolio for risk adjusted returns. And then I'm going to like use leverage and or like, holding something in cash if you want to delever the portfolio to adjust how much exposure I have there because, I'm 78 years old and I don't need to take I don't want to take a lot of risk. I'm fine holding a bunch of stuff in cash because, that's where I am in my life, et cetera.
I'm not going to YOLO on Dogecoin at 78 because the returns might not be worth what's on the other side of that. Taylor, I want to go back to something that I'm really interested in. And, you said one of the things that you don't try to do is predict when something is going to happen, right? And you kind of accepted that you don't know when a black swan event is going to happen or some one of these things. Yet, you've created something called Mutiny Fund, which clearly you understand the importance of being prepared for these things. Do you feel like that most people are unprepared for a upcoming black swan event or some sort of an event that's going to change how we think about finance, how we think about the economy, and potentially our world?
I think some sort of obvious observations. One is like people have a strong recency bias. Like there's a lot of psychological literature around that. That's like not a super controversial thing to say. So the general assumption is like things will be like they've been recently. We were chatting over email or something. We're recording this February 2nd. Last week was like a little bit hectic in the equity markets. I want to say like Monday around noon Eastern, like the S&P was down 11% or something. And like people were losing their minds at like the stock market selling off 11%. Because it, basically since March of 2020, it hasn't, it's just been kind of straight up and to the right. But I don't remember the exact statistics, but like over the last 30 years, that's happened like 50 times or something. Like it's not that's not a black swan occurrence, right? That's like, it happens on average every 6 to 9 months or something. And whatever life goes on, a bunch of things are adjusted. So I think there is, coming back to earlier stuff about like stock bond correlations and sort of the way people construct portfolios, right? There's just sort of this like, this is what I've seen in my lifetime. And so I kind of assume this is how stuff works, and sort of an unwillingness or just sort of like not wanting to look at the other thing. I don't, sort of beyond that, I don't really have a lot of strong feelings. I think there's like some pretty interesting research, which I don't have a ton of I don't know. I don't. It's compelling to me, but I don't have any really way to like prove it, nor does anyone else, about just like the level at which sort of the global financial system is interconnected and how sort of dependent things are. And you can get into like leverage here, and then you go down the money printing route and the Fed and all that kind of stuff. But even sort of like setting that aside, just like, and I think like COVID was a good example of this, like the thing spread really fast, right? Because 100 years ago, people weren't like flying back and forth from Beijing to Los Angeles thousands of times a day, but right, that's sort of the world we live in now. Same with financial markets, things can move faster. So I think there's some interesting research around like contagion effects, right? Like, can these things sort of spread and ripple across markets at a speed in which they couldn't historically because of just how interconnected all the markets are? But that's fairly idle speculation. Like, I think the more probably appropriate question is just like historically what's been the case, and like, am I prepared for that? And then maybe there's some little qualitative like, well, I think things are slightly riskier now, so maybe I tilt things a little bit that way or something like that.
Yeah. Have you been following anything from Ray Dalio, like his new book about changing world order and these debt super cycles?
I have not. I'm familiar with his like debt super cycle theory, and all that kind of stuff. I mean, I think it's an interesting example of like the promise and the peril of like financial history, which is like, tell me your theory you want to support, and I can write a book using financial data from the past that supports your theory. Like, it's just like, I can always go find the sort of data there. Like, at the same time, like, what else are you going to look at? Like, right, you have to look at some like stretch of financial history and sort of how that works. So I think, the debt stuff is interesting. I don't have any strong opinions on it nor ways to sort of evaluate it.
Yeah, it's interesting. I was reading his new book and listened to a couple podcasts on it, and have read, been following along. And basically his idea is that every 50 to 75 years, basically his idea is that we have these debt cycles. The cycles last, I can't remember exactly how many years, maybe like a multi-decade or a decade. And they go in these cycle. Basically the whole idea is that rather than thinking linearly, we should be thinking more in cycles, and that there are debt cycles where things boom and then bust, boom and then bust. And then there's super cycles that are every 50 to 75 years. And his theory is that we're going to see a overlap of a debt super cycle, and then also cycles within geopolitics, and all those things are going to collide. And then on the other side of that, there'll be some level of new world order, which is kind of similar, a little bit similar to something like from the Fourth Turning. Yeah. Honestly, reading that and reading the Fourth Turning, there's a lot of overlap between the two of them. It's interesting and it's compelling because he, like to your point about, you can always go and find some historical event or sequence of event to support any book that you want to write or any thesis that you have, because there's so many things that have happened. But I think the thing that's interesting, and one of the reasons why I wanted to chat with you, is because I feel like there's some level of fear related to some changing of the new world order, and I'm interested in, I guess, how you are preparing, or how people that you're talking to are preparing, maybe outside of just getting tail risk in their portfolio. Because I know, one thing we've talked about outside of this is like going down the prepping rabbit hole, right? And preparing for things that are going on. Last year in Texas, when we had that freeze and everything broke, we lost power and water and everything for like a week. It was very interesting to see how quickly things shifted. But are there things that you're doing outside of just tail risk in your portfolio to prepare for black swan events?
Yeah, so quickly on the Dalio point, Tyler Cowan has a podcast called Conversations with Tyler. He interviewed Dalio, and I kind of pushed him on some of these points of like,
he did.
If we see this where to go. And I didn't feel like Dalio had particularly good answers, and they kind of got flustered, which was, I don't know. Again, like, it's not provable one way or the other, but I would recommend. I thought that was a really good listen, and Tyler like pushed him to some interesting new places. But yeah, sort of to your point about like things changing. One of my partners, Jeff Malik, he has this idea of like, people are familiar now with the idea of the black swan, the unexpected huge thing that happens. And so he came up with this idea of the white moose. And the white moose is what happens when you keep expecting and betting on the black swan to happen and it never materializes.
Yeah.
And so if you look at like in markets, like you have all these newsletters that like perma bear, like everything's going to blow up and you're going to have to own physical gold and like everything's, going to crap and blah, blah, blah. And it's always easier to like tell that story. Like the narrative of like things are just going to kind of keep going the way they are is like, it's just like not a very good story, right? It's like hard to write like a newsletter or like a compelling thesis around like, yeah, everything's probably just going to be more or less the same. Like there's no narrative arc. There's nothing to tell there. At like a high level, like, and I think that this is how I think about portfolio construction and everything else is like, probably things are just going to be the same. Like probably nothing is going to change that much, but like having some, we talked about like in the cottage portfolio, like over the last 100 years, like what are the different things that have happened in markets and like, is your portfolio prepared for them? That's not like preparing for some crazy thing that's never happened. That's like preparing for stuff that has happened in fairly recent history. And so it's like not crazy to think that sort of thing could happen again. And so to your point about like the Texas freeze or like sort of prepping and that kind of thing, like I think about prepping sort of in the same context, right? Like there's like the equivalent like the perma bear preppers, right? That have like their like truck with a machine gun mounted in the back, and right, it's like they're waiting for when the zombie apocalypse comes, they're gonna be like playing Halo and like shooting the zombies out of the back of their Tacoma or whatever. But then there's like sort of the more mundane but probably much more realistic of like every 100 years there's a bad freeze and you like have to live at home without power for a week, or natural disasters are the fairly obvious thing. My sort of like rough rule of thumb is like, has it happened in the last like 100 to 1,000 years? You can kind of like pick what points you want on there in terms of like how far back you want to go. And then like everything outside of that is kind of like asteroids. Like I'm not worried about asteroids. Mega volcano that blows up every 60 million years, like not worried. Like it's like those things are out of the control, and like I think that you go down a rabbit hole. But like so similar to like, is your portfolio prepared to handle things that have happened in the last 100 years? Like, are you prepared to handle things that have happened in the last 100 years? And I think that's I don't know. I kind of call it like rational prepping, which maybe is a bit of a loaded term, right? But it's like, no, do I think the world is going to end and everything's going to implode? Like, no, it's very unlikely. But if like I can do some fairly inexpensive things that prepare against something that's like reasonably likely to happen in my lifetime, that's like a pretty good bet, right? Like this will probably pay off at some point, and it's like not super expensive for me, to keep 2 weeks of water and a month of food and some camping fuel. And you're right, like it's like, I don't know, it's a few $100s a year, if that.
Yeah.
So that's kind of where I am, which is like all the prepping stuff.
Yeah. I fall in a very similar place to you, where I actually bought the optimisticprepper.com and have like built out a Notion like document with all the stuff that I find, and went back at the beginning of, or like the end of summer, and sort of to do like kind of my prep for the upcoming winter, just knowing that like, well, it's like a joke, like winter's coming, and it is, because last year was quite intense here, and learned a lot from that. It's really interesting to what you're saying about just being prepared for the last 100 years. One of the things from the book the Dalio book he talks about is like, he looked at every major index in all the major countries, and in the last 100 years, the only one that hasn't gone basically to zero is the US. And he was like, so, okay, like even if you just look in the last 100 years, you can, if we project that out 100 years in the future, most of them went to zero. So and even then, like the US had a massive drop, but it recovered. And, overall, I think probably that if you had invested since the 30s or whatever, it's hard to beat betting on America over the last 100 years. It's almost impossible. But back to that, it's kind of like, it's very interesting when you look at it from that perspective. It's a very rational, like it's rational to prepare for something like that happening again, if it did happen within the last 100 years. And we can confuse ourselves and think, okay, well, just because, especially when you look at the number of people in Wall Street who are young and have never even seen like a massive downturn. I graduated in 2009, and it was quite interesting to go into a job market where 2 years before they were recruiting all over campus, and then when I graduated, that mysteriously all the large companies that were recruiting 2 years before just didn't show up. Or they took like 3 people. I remember it was like 3 people that I knew got jobs at like the big investment banking firms in my freshman year. It was like half the people that I knew from my lacrosse team went to a big bank. So yeah, I mean, I think that same thing, the same viewpoint on preparing yourself, your financial future, bleeds into being kind of a rational prepper in the real world. You're an entrepreneur. You've got a portfolio. What can the average entrepreneur do? Someone who's making good money. Let's say they're making $500,000, $600,000 a year, putting some stuff away. How do they prepare at this point? Like, how do you think about that?
Yeah, I think it's a really good question. There's a few different ways to think about it. I was just gonna say quickly, on your point about like the freeze last night and recency bias, my wife went to the grocery store last night. We're having like a freeze coming up in like 2 or 3 days, and like the shelves were bare. Like everyone remembers the freeze last year in Texas, and is now like HEB and Trader Joe's like are just empty. Like everyone's just bought like as if we're gonna be in a month of freeze, right? Whereas like last year, no one worried about it because no one remembered it. I just thought that was a funny.
As a perfect example, there was last year when they said, "Oh, you're going to get snow." I figured it would be like every other snow that we've ever gotten here, which is like a dusting that's gone in like 45 minutes.
Right. And now everyone remembers last year, and it's, I don't know, HEB sold like 3 times their normal volume of groceries yesterday because everyone's ready for everything to blow up. But yeah, I think the case of entrepreneurs is like particularly interesting. Yeah, there's a few different ways to do that. Like, I mean, one way obviously is like I think a lot of entrepreneurs treat their business and their portfolio as like distinct things. Mm-hmm. Like it's very rare that I meet an entrepreneur that's like, well, I have this in my portfolio because I think it's uncorrelated with my business and I'm like diversifying out my business. That's typically not how most entrepreneurs think. I tend to think about it that way. Like that makes more sense to me. That like if, let's say we could value your business, you do a discounted cash flow that if you sold your business or like if you hold it, like this is what the values of the future cash flows are. If that's like 80% of your net worth or your assets, like to me, it makes sense that like the rest of your portfolio should be like super conservative and like trying to manage the risk in there, right? You have this like one really concentrated risk on bet. Most entrepreneurs don't think about it that way, but to me at least, that makes more sense. I think when this is just like logistically hard for a lot of people to do, but I think the options are getting better. Like when you think about, in investing, there's this idea of like bet sizing. And there was a guy who studied this. It's called the Kelly criterion. He was a scientist at Bell Labs who worked with Claude Shannon that developed information theory. But he basically there's a correct, if you know the odds of a bet, there's a mathematically correct way to evaluate, to size the bet appropriately, right? So if you have a coin that is 51% heads, 49% tails, and you have $1, you don't want to bet all dollar on the first flip because there's still a 49% chance you could be wrong, but you have an edge. And if you can flip 10,000 times, there's, you can compound it over time. So there's a way to calculate like how much you should bet on a 51-49 coin flip or like any sort of like distribution of outcomes. And that's true of portfolios too, right? Like what are the expected correlations or what are the expected returns? And like, how do I size things? If you own a small business, where you're a founder of a startup or whatever, like it's hard. You can't just be like, oh, I'm just going to sell this like every day. I'm going to just sell this a bit of equity or buy some of the equity back to like rebalance my portfolio to the right size, right? Because it's unexposed. But I think like taking chips on, if you have 95% of your assets in one business and you can like sell a minority share of that or something as a way to sort of like change your bet sizing there, I think that's like a really interesting opportunity that like not a lot of entrepreneurs want to go. They're like, oh, I think it's going to do really well, so I don't want to take I don't want to give up any upside, right? I don't want to give up any of the equity. But if it's already done pretty well and you're making, your example, $500,000 a year, like taking a little bit of the chips out of the table and like diversifying that somewhere else, to me seems like a kind of reasonable idea. And it seems like there's more of a demand from investors to buy those sorts of minority stakes in businesses. So I think that's like something interesting that people could go down.
I want to go in on that a little bit more. How would you think about actually doing that? I think that the practical side of that, I've had many conversations with people who want to do that. And then they're like, okay, well, how do I do that? How do I find the minority stake business owner to take over, let's say, buy 25% of my company so I can take some chips off the table?
I know some people that want to do it. So if you want to email me, I'm happy to like introduce that. But there's not a good, like, I don't have, it's like go to this people and do these kinds of things. I'm seeing like in the last year, I've seen like funds, like small funds, but funds that are starting to spring up to do this kind of stuff for software businesses or e-commerce businesses. But yeah, I don't know, right? I think it's most of the people that are doing that are like, very high net worth individuals or like small family offices where they're managing their own money and they have a high risk tolerance and they can come in and buy a, whatever, 5, 10, 20% stake. So yeah, to your point, like, I think it's hard, right? Like the secondary market for that is not developed. I don't know what your option, it's a lot more developed now than it was even like 3 or 5 years ago. So like, I think like there's options that are better there.
Do you feel like that's an opportunity for a company to come in and create that market?
Yeah, I think it is. Like it depends on the scale you're at. Like PE funds, like I know multiple people that have done this, like done a deal with the PE fund where they're selling and PE funds don't always like to buy minority stakes, but there's some that do and they will. But I'm not sure exactly what the scale of that is, but like they're writing checks in the millions of dollars, right? So if they're they're going to write a $5 million check to buy 20%, it needs to be a $25 million company. It's like they have to be at some scale, like pretty significant scale to do that. But yeah, I think there's a big demand. I think it's part of the reason PE companies don't like to buy minority stakes is like you don't have control.
Exactly.
And so I think that's figuring out how to like structure that correctly, right? Because it's like probably you need some sort of like founder salary cap, right? Like, I'm going to go sell 20% to this, but like there's not going to be any distributions because I'm just going to give myself a massive raise every year and take rights. So it's like, okay, well, that's not going to work. So yeah, I think I don't think anyone that I know of, like, there's probably some code to crack there of like how to structure those types of deals that make sense for everyone, but it seems crackable and it seems like there's demand from both sides for that.
And it seems like, to your point of trying to diversify some of your risk away from being incredibly concentrated. It's funny. Like I know a lot of founders who are all in their company, and then for their investments, they're like heavy Amazon and Shopify because it's stuff that they understand, right?
Extremely common. They just sold their Amazon business and they plowed it back into 5 more Amazon businesses.
Yes. Yeah. And that it's one of those human nature things where it's okay, buy things that you understand, right? And it's actually probably worked out really well for you. There's been things that have been, if you've been like all in on Shopify and run a Shopify brand for the last 10 years, you've
crushed
done
it
very, very well.
Yeah,
You've been crushing
absolutely.
it, right? And you're also very exposed. How do you think about it? So you talked about taking a percentage of your, let's say, net worth and putting it into more conservative things. What does it even mean to you? Like, what are conservative assets and conservative things that people can look at? Let's just put it for an e-commerce business owner, right? So they've got a brand, 80% or 70% of their net worth is in that, and then 30% they want to go towards something a little bit more conservative. What would you even look at that offsets that? That's truly offset risk-wise.
So I'll start, I guess part of the reason I got into doing this sort of stuff was, I guess it just made sense to me, but I didn't really, we graduated from college around similar times. And like, I remember 2008 and like, there weren't a lot of jobs and that kind of stuff, but like, I never like blew up a portfolio or like I didn't have any money or what, like there wasn't anything to blow up. My partner, on the other hand, the reason he got into this was he was, by all accounts, a good and successful commercial real estate developer. And he'd started in kind of the early 2000s and had built up a pretty significant commercial real estate portfolio. And, sort of was good at his job, right? Like identifying properties that could be rehabbed. He sort of had a whole philosophy of like, how it's been like retail, and like he was doing some really interesting things there. When the housing market crashed and lending dried up in 2008, it was totally irrelevant to his success as an entrepreneur how good he was at commercial real estate. He could have been the best person at commercial real estate in the world. The only thing that mattered was like how his contracts were structured with the banks and what the rest of his portfolio was doing. And so that was how he got into trying to trade volatility and derivatives. Was he sort of around 2007, he was like, this looks bad, right? Like, I don't see how this is going to make sense. And I own a ton of commercial real estate that is like similar to a business. Is illiquid. I can't sell. I can't like hit market sell tomorrow and like get rid of my commercial real estate portfolio. It would take me like years to unwind it. And so I think that, that sort of analogous to any entrepreneur or small business, right? It's like, you can't just like market sell your business tomorrow and get out of the thing. You're sort of in an illiquid thing. In terms of like, I think about like conservative or defensive assets, like the types of things I would put that in there. And I guess the sort of like technically you can talk about assets or trading strategies have either a fat right tail or a fat left tail. So a fat left tail is something that goes up a little bit most of the time, but goes down a lot sometimes. So like stocks, bonds, venture capital, private equity, most of these things have a fatter left tail. They're left skewed assets. And then you have some things which have a fatter right tail. So they tend to lose money a little bit of money most of the time, but then they make a lot of money a little bit of the time. And that's going to be things like, long volatility, tail risk strategies, commodity trend strategies. So getting a commodity exposure, using various active management. Gold is kind of like a question mark where people put it in there. You could sort of like make an argument either way, but arguably precious metals have something of a right skewed profile. Certainly, like it looks very right skewed in the 70s when gold had a massive run. I know like everyone hates cash right now because CPI inflation is like 7%, but having some cash cushion is not the end of the world, and it can make sense for a lot of people. So, my sort of the starting place for me and what I recommend to people, there's a guy from the 70s, his name is Harry Brown. He came up with this concept for the permanent portfolio. It's stupid simple. It's equal parts stocks, long-term U.S. government bonds, gold, and cash. It's like 4 assets. And there's been like, it really sort of Ray Dalio's all-weather product is kind of a variation of that, where he just like levered up the bonds for the most part. Like there's some other wrinkles and some stuff in there. But that's sort of like general 4-quadrant framework of stocks, fixed income, cash or some other defensive thing, and gold, where you can kind of map it to there's basically 4 macroeconomic environments. There's growth and recession, and there's inflation and deflation. And you can get combinations thereof. And so assets that do well in recession or inflation, I would typically label like defensive or conservative assets. So like commodities or treasury inflation protect tips, securities, right? Those are things that potentially do well in inflation. We don't know. We never know what anything's going to do, but those would be the types of things. So like in a recession, cash is good. Volatility strategies can do well. Certain types of trend strategies can do well. Those are sort of the things I would lump into defensive.
What are you thinking about cash right now? I mean, you mentioned it, right? Everyone's nervous about holding amounts of cash because inflation's at 7%, and everybody feels it. It probably is at a higher level than 7%. If you just go to the grocery store or look at housing prices. We're based in Austin. It's increased by substantially more than 7% over 1 year. And so there's a fear around holding cash. Is there anything you can do right now with your cash to be able to get a better return? Is there anything innovative, or is it just you just suck it up and hold on to cash and just lose 7% a year purely for the optionality of deploying it when a market drops or whatever?
I think for me, this comes back to our earlier discussion around like bet sizing. Like I think there tends to be this like tendency to think about like, oh, cash is good or cash is bad. And really the question is like, what is the right amount of cash to have, right? And so if I was like, someone's like, I want to hold 3% of my portfolio in cash. Should I be worried about inflation? It's like, no, probably not, because losing 7% of 3% is like, I can't do the math in my head, but 20 basis points or something, right? Like it's a 0.2%. It's like not a super material amount. So I think like that to me is kind of the question, right? It's like depending on your other exposures, like what is an appropriate amount of cash for someone to have, right? And if you have 90%, 95% invested in your business and stocks, whatever else you're doing, like holding 5 to 10% cash doesn't seem crazy to me. There's other ways to think about that. And that might not be the right option, but I think it's like going back to the sort of permanent portfolio four quadrant framework, like his idea, which is sort of what we started building our own portfolios based off of, is like, I don't know what macroeconomic environment's going to have, so I'm just going to like put equal parts in each thing. I'm going to put 25% in markets in growth. I'm going to put 25% in recession. I'm going to put 25% in inflation, and I'm going to put 25% that does well in deflation, because I don't know, and it's going to go either way. And so, in that portfolio, if stocks are doing well and inflation is high, like, yeah, you're losing money on the cash side of your portfolio and you're losing money on the bonds side of your portfolio, but you're making money on the commodities, gold part of your portfolio, and you're making money on the stocks part of your portfolio. And so going back to our earlier thing about like long-term growth, like the compound annual growth rate of the portfolio, if you're rebalancing those pieces, what that is trying to do is buy low, sell high, right? As something starts going up, you're selling a little bit of it to buy the things that's been going down. And then, when things flip, you're in the better position. So I think that, to your point about like optionality, like the interesting thing for me about sort of long volatility strategies, or even just something like holding cash, is not like what, like it's really, they do that, slight tangent here, but they do these things where they try to decompose the returns of a portfolio, like what generated the return, right? There's all these things in the portfolio. But one of the things that happens in a diversified portfolio is you have this rebalancing premium, right? So let's just say you had a really simple portfolio that was 50% stocks, 50% cash going into March of 2020. So that you started in 2018 and the stocks kept going up and you kept selling a little bit of the stocks all the time as they were going up and like putting them into cash. And then stocks went down a lot. And so what did you do? You like had a bunch of cash. And so you went and you bought stocks at the low. So then stocks went back up a lot. So is what caused that gain, do you attribute that in your portfolio to stocks, or do you attribute that to cash? Because the only reason you could buy the stocks at that time was because you had the cash on the side. So it's really hard to talk about that stuff, right? Because it's not kind of clear. But I think that rebalancing component is like, that's the compelling and really important thing, right? It's not, oh, I'm losing 7% of my cash. It's like, okay, what is the overall portfolio doing? And like, what role does this play in that portfolio? And does that make sense holistically?
Sure. That makes sense. It's interesting when you think of it like that, and you think about, you would have performed quite well if you'd been rebalancing kind of continuously. I guess on the rebalancing part of things, how often should people think about rebalancing?
A lot of that's a tax question. So a lot of it depends on like your individual tax. Like if you're rebalancing inside of it's a tax and transaction cost question. So like inside of a retirement account that's non-taxable and you're not paying any trading fees, like probably more frequently is better. Like I know people that do it weekly. If you want to do it that frequently, but right, if you're creating a taxable event and you pay trading costs, or you have to cross you're crossing the spread to do it, then less frequently. But sort of Harry Brown's idea in permanent portfolio was you just have rebalancing bands. So let's say you're going to have equal parts stocks, bonds, gold, and cash at 25% each. So let's just say you have rebalancing bands between 20 and 30%. So when something gets above 30 or below 20, you rebalance the whole portfolio. If you do something like that for like assets with fairly normal volatility, maybe you're doing it once every year or two or something. So it's like usually fairly tax efficient because it's going to be long-term gains when you rebalance the portfolio. And it's like not that much work, right? Like you just monitor it.
Helps protect against your human nature to let the winners continue to ride until they ride off a cliff.
Yeah, it's the doing the rebalancing is, there's the understanding why the rebalancing is important, but the getting yourself to do it is equally challenging in many cases.
Taylor, it's been awesome. I really appreciate you hopping on here and walking us through the stuff that you've really dove into and become an expert in. For people who are listening and are interested in learning more about either working with you or investing with you, where would you direct them?
So mutinyfund.com is our website. And then my personal website is myname.me. So Taylor Pearson, Taylor as in Taylor Swift, Pearson, Pearson.me. And I'm on Twitter. Really,
Awesome.
Twitter is the best place. I'm at Taylor Pearson, and I spend a lot of time on Twitter. So
Go on Twitter and respond to Taylor Pearson's tweets in all caps.
yes, I like that. I really appreciate that.
Emphatic. Just show up in all caps. And if you do that, it'll be funny because then we'll know that it came from this podcast.
That's true. I like it.
Taylor, awesome to chat with you. And thank you for coming on and talking to us.
Thanks for having me.